This is my thesis right now. I believe they are going to intentionally destroy the dollar. They're going to destroy the dollar to support the system. I think what they're doing with the stablecoin legislation is they are trying to move the majority of debt issuance to the short end of the curve through stablecoin issue, because you are seeing the governments that used to support our debt are no longer doing so, right? You have now the Cayman Islands and the United Kingdom and Ireland. It's a joke. And they understand that the amount of debt, we have to come up with $28 trillion in debt in 3 years when we only take in $15 trillion in tax revenue. We're not there. They understand that. And we're seeing less and less and less buying of our treasuries. So instead, they passed the stablecoin law where all of these stablecoins will be backed by US dollars in order to have demand for a treasury market that is losing demand. So you put that all on the short end of the curve, right? Where I think they're going to do it, and kind of blur the significance of the long end, which I'll get to in a moment. But I think that's first and foremost what they're trying to do. Remember when Janet Yellen did that? That was good for gold. That was good for stocks. It was inflationary. And I think that's what they're going to try to do. At the same time, they reshore all the gold and they're going to let it go higher and higher and higher and higher. Not very easy for the public to discern. There'll be volatility. There'll be consolidation, but it will keep going higher until people feel it's gotten too high. And then they'll probably come in and revalue it to a level much higher. And they're going to peg it to the treasury. Why would they do that? Why would they peg gold to the back end of the treasury market? The short end, the front end, will be backed by these stable coins, which they will pump out by the gazillions, because now they have this synthetic demand, not a organic demand like we used to have when we were revered and we ran a surplus and we didn't instigate wars all over the world and fund wars all over the world, and we're not revered anymore. So the back end of the market, who the hell wants, and especially when Trump talks about creating all of this money to rebuild our infrastructure. So in essence, printing money to build our infrastructure to compete with the rest of the world. They don't want to buy our treasuries. So they will just do the stable coins to get all of this demand for the front end and load the debt there. But the back end, I believe they will peg to gold. As Judy Shelton has said, on July 4th, next year, the 250th anniversary, he has said it repeatedly. Again, she keeps saying it on Twitter. He will peg 50-year treasury to gold. Why would you do that? And you have to get gold much higher. And I think she keeps talking about gold revaluation. They will revalue gold. And I think Luke Groman, one of the smartest dudes I've ever met, he's talking about revaluing gold. He thinks they'll let it go to $7,000, $8,000, $10,000 and then revalue it to a much higher level to give the Treasury General account $5-6 trillion in free, clear revenue without selling an ounce of gold. And we talked about how that happens. There's miscommunication on that too, because some people think that when the Treasury issues Treasury certificate or gold certificates, gives them to the Fed creates the money, takes the gold, and gives the Treasury money free and clear. Every $4,000 increase is $1 trillion free and clear to the TGA account. The Fed doesn't have control of that gold. They have control of the fiat. They're owed the money value of that gold, not the gold itself. Anyways, if they do that and peg it to the long end of the bond market, she said 50 years first, shorter durations, maybe 30 and 20. Later, maybe 10. But why would you do that? Because now you can have zero borrowing costs. You can put a zero coupon on that. The gold redemption at the end is the borrowing, is the interest rate, is the inflation gauge. The more foolish we are in monetary policy, the higher the price of gold goes. To be able to get that at redemption would allow for long end low borrowing costs, almost down to nothing, which would then enable us to slowly reshore our manufacturing at very low borrowing costs, and then to grow our way out of this problem eventually. The only way you get rid of inflation and where we are right now is to produce our way out of it. And we're a long ways away from that, because in order to facilitate the amount of debt that we owe, pay it off, just the $28 trillion in maturing Treasury debt by 2028 with $15 trillion in revenue, we're halfway there. And that doesn't take into account the $3 trillion a year in deficit spending. So you're 25% of the way there. So you have to inflate. They're going to destroy the dollar. They're going to inflate the crap out of it. They're going to use the stablecoin legislation to front load debt issuance into the front end of the market. And then they will let gold go to the heavens. I believe this. Truly, I do. And they will peg it to the long end of the bond market to have zero borrowing costs to reshore manufacturing, to sell treasury debt, bonds at a much longer duration at a zero borrowing costs redeemable in gold. I think they're going to do this. I truly do. And I guess we'll see. But I think to save in dollars now is the dumbest thing you can possibly do. You're destined to go broke. They're going to destroy the value of the dollar. They are going to inflate the crap out of it. There is no other way, period. So that is my thesis right now, and I'm very, very convinced that this is something that they are, if not implementing right now, it is, by all of the things that we hear and see. It'd be too long for me to go through the whole litany of.
By the time this is over, I think a lot of people who have been sitting comfortably in dollars are going to have that frog in boiling water moment. Except the water won't just be warm, it'll be scalding, and the exit will be blocked by the very people who lit the fire. Look, I've been in this market long enough to know when we're past the point of academic debate. What's happening now is not a theory, it's a plan. The architecture's already being built, and if you can't see it, it's because you're looking for smoke when the fire's underground. They're going to destroy the dollar, not by accident, not through some slow, bumbling incompetence, but by design to keep the system breathing just a little longer. Here's the thing. In a world where the traditional buyers of US debt, foreign central banks, surplus nations, are quietly stepping back, you either create new buyers or you watch your borrowing costs rip the face off your budget. And lately, the buyers showing up at Treasury auctions look less like the old guard and more like a Cayman Islands P.O. box. This isn't the kind of organic, deep-pocketed demand we had when the US was running a surplus, when our foreign policy didn't look like a global tour of funding conflicts, and when the dollar's prestige was untouchable. That demand is gone, and it's not coming back. So here's the workaround. You legislate demand. That's what this stablecoin push is really about. Make it law that stablecoins have to be backed by short-term US treasuries, and suddenly you've got a synthetic bid for the front end of the curve. No need to convince a reluctant China or a skeptical Saudi Arabia. You just build the pipe so that billions of dollars in stablecoin issuance automatically soaks up your T-bills. It's like turning DeFi into a captive treasury ETF, only with a shinier marketing campaign. Of course, the long end of the curve, those 20, 30, even 50-year bonds, is another story. Who in their right mind is locking up money for decades in a currency you're deliberately inflating away? That's where the other half of the plan comes in, and if you've been listening to Judy Shelton, you've already heard the hints. She's talking about pegging the long end of the curve to gold, not at today's price, but at a revalued level much higher. Now, before you roll your eyes, remember that gold revaluations aren't some wild-eyed fantasy. They've happened before. Roosevelt did it in 1934, taking gold from $20.67 to $35 an ounce overnight, a 69% devaluation of the dollar against gold. In today's terms, that'd be like waking up and finding gold at $6,000. Luke Groman's been saying it too. Let gold run to $7,000, $8,000, even $10,000. Then officially repeg at a level that instantly repairs the Treasury's balance sheet without selling an ounce of physical. At $10,000 an ounce, the US's official gold holdings would be worth north of $260 billion. A revaluation to, say, $50,000 would create trillions in paper equity for the government. Imagine a 50-year treasury with a zero coupon yield, backed by gold at redemption. The interest is the appreciation in the gold price over that half-century. If the government plays it straight, the gold's worth the same or more, and the investor's happy. If the government plays it stupid, the gold's worth a lot more, and that's the investor's compensation for bad policy. Either way, the Treasury gets to borrow for practically nothing in nominal terms because the market is pricing the gold, not the dollar coupon. This isn't just about lowering borrowing costs. It's about creating a mechanism for reindustrializing America without collapsing under the weight of interest payments. Picture Trump, or any president with a populist manufacturing agenda, greenlighting trillions in infrastructure spending, promising to bring jobs home, while the Fed quietly mops up the front end of the curve with stablecoin-backed demand and funds the long end through gold-pegged bonds. It's fiscal steroid use with a hard asset fig leaf. And here's the punchline. They can sell it as sound money. They can point to the gold peg and say, "See? We're disciplined now." Never mind that the front end of the curve is being flooded with synthetic demand and the dollar is being inflated on purpose. To the average voter, gold-backed bonds, sound like a return to the good old days. That's the genius, nor the cruelty of it. There will be volatility. The gold price will spike, then correct, then spike again. The mainstream will call each correction the end of the gold trade, just like they have for the past 50 years. But the direction will be higher because the revaluation target is baked into the strategy. And when they finally set the peg, it'll be at a number that feels obscene compared to today. Not because gold's worth more in real terms, but because the dollar's worth less.
I've been thinking a lot about the gold to silver ratio. And, you got Goldman Sachs and JP Morgan forecasting $4,000 gold by next year. I think that's pretty reasonable, actually, on many levels. But assuming that plays out and the gold to silver ratio were to get to 50 to 1, where it's averaged about 45 to 1 for the last 150 years. At 50 to 1, which is very conservative, at a $4,000 gold ratio, that puts silver at $80 an ounce. I mean, you're talking a double, easy double. And so when I think about where silver could ultimately go, there are so many things that are screaming silver and its value right now. UBS just raised its target to $42 an ounce. That's about an 11% increase. But when you look at all of the things that have been happening, to me, whether it be the increase in the lease rate, the lack of shares available to short or to buy to cover shorts on SLV, the massive delay from T+1 settlement in London to T+8 weeks in London, the huge deliveries. When you look at the distortions that we find in the silver market, when you look at a simple returning to 50 to 1, even if you went to 70 to 1, where it was just a couple of years ago, that puts silver at basically $60 an ounce. That's a solid, 50% gain almost. So you're talking about, I think, the value of a generation. And it seems that things are changing, the way that the market is moving. We're not seeing these massive sell-offs. We're seeing consolidation, choppiness, volatility, but the strength is something that is very different than what we've witnessed before. I'm very, very, very hopeful for what the rest of the year brings for the price of silver. I find it interesting that the LBMA came out the other day and warned of counterfeited metal, which they said distorts prices by creating artificial supply. And you think about that for a second and think this is the institution that's trading billions in unallocated bullion contracts unbacked, selling claims on gold and silver you can't deliver. Doesn't that kind of sound like you're creating artificial supply, counterfeiting in a digital form? I don't know. I'm just throw that out there. I laughed when I read that. But again, UBS is saying 38 to 42 through September 2025. They're talking just in a month through June 2026. So they're basically saying we're right there. By the way, for the people who we're recording this on Monday, the options expire today. So I expect today to be volatile, just like Friday was and Thursday, but I expect it to shoot right back up tomorrow. We'll see if I'm right when the next contract hits the board. You have to wonder, is it a conspiracy or is it reality when you talk about when Chris Powell says there are no free markets, just manipulations? The traders suck in the speculators, and then right at the end, they smash the price so that the options expire worthless. The big banks get to keep the premium on that, and then it goes right back up. They rinse, wash, and repeat. But this is a game that's much more difficult to do so. And it kind of reeks like we're getting to the end of this game.
If you've been following along, you already know this isn't about gold as some shiny relic of the past. It's about gold as the future anchor in a system that's already halfway down the slide toward a controlled demolition of the dollar's purchasing power. And here's the uncomfortable truth. Most people will cheer for the very policies that are robbing them, because they'll be packaged as solutions to problems the same architects helped create. When you hear words like monetary innovation, bridging traditional finance and blockchain, or unlocking domestic manufacturing, remember this. The fine print isn't in the press release, it's in the balance sheet. The public will be shown the stablecoin play as a breakthrough. Instant settlement, Blockchain transparency, lower fees. They'll point to the volatility of unbacked crypto and say, see, this fixes that. What they won't emphasize is that every stablecoin dollar now equals a T-bill purchase. And because the crypto space still thinks in terms of scale and speed, they'll push issuance like crazy, bragging about daily transaction volume without noticing they've become the de facto marketing arm for the Treasury's short-term debt machine. Think about it. Billions in demand, on autopilot, every time new coins are minted. It's like giving a blood transfusion to a patient who won't stop bleeding, except in this case, the patient is the US government, and the blood bank is anyone using digital dollars. But the real pivot, the one history books will focus on, is the gold peg on the long end. Because in that moment, the US will admit two things it hasn't admitted since Nixon closed the gold window in 1971. One, that the dollar needs a hard anchor to regain credibility, and two, that the old model of unbacked infinite debt issuance has reached terminal velocity. They'll dress it up as bold leadership. They'll say, we're returning to fiscal responsibility, and the crowd will applaud because in nominal terms, they'll see gold prices that look like fantasy land today. Here's the part I think most people miss. Pegging long-dated treasuries to gold isn't just about borrowing costs. It's about creating a parallel pricing signal for inflation that isn't CPI. If you're holding a 50-year gold-backed treasury, your real yield is the gold redemption value at maturity. That means if monetary policy goes off the rails, the redemption value rises, giving you a natural hedge. In other words, the government will have created an asset where its own mismanagement is the investor's alpha. That's the discipline story they'll sell, even though the short end will still be a printing press disguised as DeFi innovation. Let's talk about winners and losers in this setup. Winners? Anyone holding physical gold before the revaluation. Stablecoin issuers who suddenly become critical infrastructure for treasury funding. Politicians who can claim they fixed the debt market without cutting a dime in spending. Losers? Savers in cash. Foreign holders of unhedged treasuries. And here's the twist. Anyone who thinks they can time the gold revaluation perfectly with paper positions. Because when this thing moves, it won't send an email first. Look at history. When Roosevelt revalued gold, US citizens weren't allowed to hold it privately in monetary form. You had to sell it to the government at the old price, then watch them mark it up by 69% for their own balance sheet. When France tried to maintain a gold peg in the late 20s, they accumulated so much metal that it broke the London market. When Bretton Woods collapsed, the change happened over a weekend. The lesson? If you're not already positioned when the announcement hits, you're a spectator, not a participant. And positioning doesn't just mean buy gold. It means think about your liquidity in a system that might look at large physical purchases as destabilizing if done after the fact. It means considering silver, which historically outpaces gold in percentage terms during revaluations because it's both a monetary and industrial metal. It means understanding that the bridge between the old system and the new one might involve capital controls. Not because they hate you, but because they'll say they need orderly markets during the transition. Some of you will remember tweets from last cycle's inflation spike. At Stacker Dan, try moving $250,000 into gold in one wire transfer. Watch how fast your bank compliance desk calls. Or bond shorter 69. Zero coupon gold bonds? We've come full circle, and it only took a century. There's also the geopolitical angle. If the US does this, it forces other major economies to respond. China's been hoarding gold for years, both openly and through opaque channels like import flows to Hong Kong and Switzerland. Russia's been pegging oil to gold informally by offering discounts to friendly nations willing to settle in metal. If Washington revalues gold, the rest of the BRICS Plus network will see it as confirmation that the dollar era has peaked. Some will follow with their own gold-linked instruments. Others will double down on resource-backed trade. But nobody will be fooled into thinking this is a return to sound money in the old sense. They'll see it as a chess move in the endgame of debt-based currency. Now, what about the average investor watching this unfold? The danger is thinking this will be a smooth, upward glide for gold. It won't. There will be engineered pullbacks, sometimes violent, to shake out leveraged players and convince the masses that the top is in. This is where having physical, unencumbered metal makes the difference. Paper gold, futures, unallocated accounts, ETFs that don't guarantee redemption are the first things that get jammed when delivery becomes a political question. Ask anyone who traded nickel when the LME canceled trades to save a short position. The same thing can happen in gold. The dollar destruction isn't some abstract macro thesis. You can see it in real time if you track the composition of treasury buyers. The Fed can't keep buying forever without admitting it's monetizing debt. Foreigners aren't buying like they used to. That leaves domestic institutions, which are either unwilling or unable to take the size needed. Enter the stablecoin bid. It's mechanical, it's scalable, and it's opaque enough that most people won't notice it's debt monetization with extra steps. I want to make one thing absolutely clear. Saving in dollars now, thinking you'll just rotate later, is playing chicken with a freight train. The train doesn't swerve. They are telling you in plain language that inflation is their tool. They need it to cut the real value of the debt. They can't get there with rate cuts alone without triggering a currency crisis, so they'll pair inflation with this two-tier debt structure. Synthetic demand at the front, gold peg at the back. That's the blueprint. Could they fail? Sure. Politics could derail the gold peg if it's seen as favoring the wealthy. Stablecoin regulation could stumble if there's a major hack or fraud in the sector. Foreign retaliation could take the form of dumping treasuries faster than the new demand can absorb. But if you think the planners haven't gamed those scenarios, you're underestimating how long they've been laying this track. The final phase, and this is where I think Luke Gromen is dead on, is the revaluation itself. It's not just about picking a number. It's about picking the number that closes the gap on the Treasury's liabilities in one stroke. At $50,000 gold, the U.S. could on paper cover an enormous chunk of its debt without issuing a single new bond. That's the magic trick. Turn a pile of metal in Fort Knox into trillions in balance sheet equity overnight. And they can do it without selling it, just by saying, this is the new price and our long bonds are redeemable at that rate. At that moment, the world will split into two camps. Those who saw it coming and those who call it a shock. If you're in the first camp, you'll already have positioned in hard assets, maybe even in related plays like high-quality mining equities. If you're in the second camp, you'll scramble to adjust, buying into a market that's gapping higher on limited supply. That's how wealth transfers happen. Not through slow erosion, but through sudden repricing events that most people are psychologically unprepared for. So here's my advice, for whatever it's worth. Stop thinking about the dollar as the measure of value, and start thinking about it as the thing being measured. If the ruler keeps shrinking, your measurements are meaningless. Gold isn't going up, the dollar's going down. The sooner you internalize that, the sooner you'll stop asking, is it too late to buy? And start asking, how much unshrinkable value do I need before the reset? If you wait for the headlines to tell you it's happening, you're already behind. Position now, diversify into real assets. Watch the legislative moves on stablecoins like a hawk. Pay attention to every whisper from Treasury about innovative debt products. And when gold starts moving in a way that makes no sense relative to COMEX positioning, understand that you're watching the prelude to the revaluation. Because when this curtain finally comes up, the show will already be halfway over.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.